Friends, in this video for I Thought Wealth, I am going to talk to you on the topic, the meltdown in small caps. The markets have been weak for days together. We saw weakness right through the month of May. We have seen weakness right through the month of June. But something very interesting is happening in small caps. While they held up reasonably well through May, even when the index was weak, the past few days are seeing a capitulation. This capitulation has gained momentum, especially after the recent increase in US interest rates. What is happening in small caps? Basically, the rally or the boom in small caps became secular and all boats went up in high tide. And now, when the tide is running low, we are going to see a very ugly sight. Clearly, liquidity did more to small caps than to the indices. This is the worst kept secret of this bull run. There is so much liquidity, so much of money chasing ideas that the valuations of small caps expanded to a level never seen in recent history. Also, falling inflation after the first COVID wave gave a sense that earnings are going to expand from here and there is no looking back. But rising inflation has swiftly reversed that, and it has happened at a time when small caps valuations were very stretched. So when the valuations are stretched, if you are seeing a reversal in the earnings momentum, it's natural for those who have bought these stocks at higher levels to be very anxious. And when you see these stocks fall 10%, 15% in 2 sessions, it is this anxiety which is playing out. People are trying to somehow get out before it's too late. This affects even those investors who have been steadfast and believed in these companies from much earlier valuation levels. So you could be somebody who bought a share at 100 rupees, but the guy who has bought it at 900 is going to sell it from 500 all the way down. This is something which the recent investors in small cap investing are not mentally prepared for, because you've seen a one-way rise in small caps over the past 2 years. There's also one more very important aspect to this whole small cap capitulation. The whole small cap boom was driven by what I call as P&L investing. Your sales goes up, your earnings goes up, and you expand the PE ratio without bothering about where the money which is made in this P&L is going. If you start looking into the balance sheet to see where this money was going, first it went into capex, then you find that whatever money the company will make will go into working capital. So what is left for shareholders? What is left for shareholders is a long wait when the company will once again throw out significant cash. But in between, inflation, various other factors are going to play on the valuations of the company. So you are seeing companies derate, valuations come down, PE ratios shrink, and you are seeing institutional investors panic. There is also another aspect to small cap investing which is a very significant risk, and it has remained so for quite some time. That is concentrated ownership of shares by a few institutional investors in companies. When I say institutional investors, don't think it is just mutual funds, it could be even PMSs, AIFs, pipe investors. So they have held very significant shareholding in individual companies which are very small. Because they held shares for a very long time, When newer investors came to buy shares in these companies, there was a scarcity. And this scarcity led to the expansion of valuations. The expansion of valuations because of scarcity was unnatural. Sometimes it was beyond all logic. Interestingly, some of these pipe investors have also sold these shares because they wanted to book profits or because they simply lost faith in the company. This has led to a sudden increase in supply in many of these companies. When such increase in supply happens, the valuation naturally loses that scarcity premium. You will see valuations shrink and supply increase. So it's a reversal of the virtuous cycle which we saw earlier. So it's going to be a derating of companies because of technical factors, liquidity in the company's stock price, inflation, and derating of small cap itself as a category. It does not mean that I am bearish on small caps as a category. It just means that you have to be very, very careful when you do small cap investing. You have to be company specific, industry specific, theme specific, and very strict on valuations. When you show the kind of leniency we showed, then you are repeating the same mistake of 2018. And the consequences are again playing out in a very similar fashion. But having said that, the coming quarters is going to be very interesting for anyone who wants to be a good student of small cap investing. Study how companies are losing valuations, because when you understand why companies lose valuations, you also begin to understand what can bring those valuations back. And some companies are capable of bringing those valuations back. But the vast majority for whom that valuation was mere froth are not going to create froth again in the same beer mug. You need a different version of that company to create froth. So that is not going to happen so easily, and it's going to be a long while before these companies come back into fashion. It's important to differentiate between companies which have that capacity to reinvent themselves and again capture the imagination of investors, and companies for whom the recent showing was more a one-off and not something sustainable. There has been a lot of mixing up of companies with sustainable potential and companies which don't have such potential. It's important to separate the grain from the chaff, and it's important to do it before it's too late. The most fascinating part of small cap investing is to go where nobody goes, to wait and then to buy those businesses when they come into your zone of valuation. I believe that quite a few of the IPOs which happened in the recent past will offer opportunities to many of you. It's important to track those companies without putting your money and to understand how they are growing, what is the potential, and for how long they would be able to grow with the capital they already have. Essentially, we are entering a phase when you should do a lot of homework in small caps and not rush to invest. We are going towards a phase where inflation is going to bite small caps more than they bite bigger companies. And companies would have expanded capacity and would need more capital to even run those capacities, because inflation means more working capital. When the economic context changes, small cap investing is bound to reflect that. Somewhere I think we underestimated the impact of macros on small caps. The coming quarters are definitely going to show us how macros impact each small cap, and some small caps are going to get a knock on the chin. Those who are excessively valued, where valuations went above what is a reasonable zone, are going to be the ones most affected. As an investor, you should be very company specific. You should now go deeper into the balance sheet of that small cap company, understand where capital is and how the capital will create more capital on the P&L side. It's no more just a P&L game. It's a balance sheet game, and you have to understand how the balance sheet will transform over the next 2 or 3 years, because The balance sheet should have the capacity to support the P&L, and the P&L should be able to survive to give us better performance. Essentially, it's going to be a stress test of small caps, and I hope it's not a stress test of the small cap investor. Thank you for watching this video.